to see who's in. We've got 2 people here today. Let me know if you cannot hear me. I think I had some audio issues last week, and I hope it's better today. Again, Monday morning. And again, last Wednesday, remember, we didn't have any meetings, so it's been a week since we did meet. Today's agenda is we're going to be into chapter 6. We're going to talk about closing entries. How do you do closing? What are they? What's the purpose? I'm going to show you a little whiteboard in a second here. I'm going to give you an illustration of where we're at, and I'll walk you through some of the PowerPoint slides, and then my intent is to at least work 1 or 2 problems with chapter 6 in the Connect homework. The goal is still this week is chapter 6. We should be able to finish this up this week. Your exam 2 is ready to go. The plan is for that to be next week. But again, I'll talk more about that on Wednesday once we get through today and most of Wednesday's session. But yeah, the exam 2, just to kind of give you a heads up, is right around the corner. It's coming. It's kind of crazy. Today is what, the 26th, I guess. And next week we are already into November. So just kind of the time perspective, it seems like it's going really fast here. But in any case, and then of course, just to kind of look ahead, once we get through chapter 6, and then you'll have exam 2, and then right after that, there's a project that I'm going to walk you through. I'll spend at least a day working on the project. I'll show you how to get into Connect to work that. And then believe it or not, after that, we'll just have a few weeks left, which we're going to go back over. We'll be focusing more on some of these adjusting entries. We'll do more of the adjusting entries, and we'll wrap up the semester with just looking at financial statements, just looking at what goes into these financial statements, analyzing them, and doing some interpretations. So again, just kind of give you some perspective. And since I've just been talking, we had about a few more people joined in. So, all right, so I am going to start. So in a moment, before I bring up the PowerPoint slide, the lecture part of it, which again I've already recorded, do make sure that you go back into Blackboard and watch my videos. At times, sometimes if my audio goes out or something, you can't hear it. I do know all my videos that I have recorded in Blackboard should have good volume, good. You should be able to hear my audio as well. So. But anyway, let me share my screen for a second here, just to give you a perspective of where we're at. All right, so hopefully you can see that. And so remember, this segment of the course, what we've been doing, and I'm kind of even going back to chapter 4, because that's what your exam 2 will be, chapters 4, 5, and 6. But the basic idea is this, and then again, here's my illustration. Here's my visual I'm trying to give you. So just remember that when we introduce the concept of a journal in chapter 4, remember the journal is where we record all of our transactions. And then from the journal, we post to our ledger. And again, a ledger, remember your ledger is your T account idea. It's summarizing all your journal transactions into each account. And then of course, from your ledger, we then can prepare our financial statements. Now, what we did in chapter 5 is we did those things called your adjusting entries or your adjustments. And of course, we would prepare those in your journal and then post them to the ledger, and then of course, prepare your financial statements, okay? So right up to that point, we think of it like where we're at right now is we've got the financial statements prepared, and typically in accounting, you prepare your financial statements over certain periods, like every month. Usually they do it by month, and then you summarize the whole year or by the quarter. Sometimes you do it every 3 months. But we're at the point where we have prepared the financial statements, and now we're getting ready to look at the next period. So in most businesses, they call this the accounting, the closing of the month or the close period. And typically what happens in the close is you get all this stuff and you get all this stuff prepared and gathered. And then at some point in time, we need to do what they call a reset or a close. And what's going to happen there, and this is where we're at right now in chapter 6, is we're going to go back into the ledger and look at what they call the temporary accounts in the ledger, and we're going to reset these accounts to 0 or close them out per se to 0 so that you can start to use them again in the next period. That's all it is. You're not closing them out to say you're never going to use them again. It's just a temporary reset that you do typically after you prepare your financial statements. And so what we'll get into today before we do those closing entries, and we'll talk about this in a moment, is what is a temporary account versus a permanent account. And then once we've identified what those accounts are, those are going to be the accounts we're going to work with in this chapter, just to show you how to close those out, show you how we're doing it, and then show you where they're going. And typically, just to kind of give you a heads up, I will follow the textbook approach. They do it in 4 entries. And yes, we're still going to be doing all the closing in our journal, but I'll show you the 4 different entries. They're called 4 closing entries that we'll do. And I hope to show you an example today in the Connect homework. And so that's kind of what we're going to be getting into in a moment. And so in any case, so let me clear this out for a second. So once we've done that, so remember in our journal, that's the first place we always go to. So once we get to that, before we get to that, we have to know what is a temporary account versus a permanent account. And these are real easy to remember. And here's basically my in-class notes I would give you if we were in person. Here's how I would tell you to remember these. So let me start first with the permanent accounts. The permanent accounts are accounts that are listed on the balance sheet. So if you can remember the accounting equation, right? Assets equals your liabilities plus equity. If you can remember what your asset accounts are, what your liability accounts are, accounts payable, and of course your capital account, which is your equity, that's called the permanent accounts. They are not closed out. So what is closed out in this chapter, to show you how to reset that, is your temporary accounts. Your temporary accounts are your revenue accounts, your expense accounts, and the drawing account. That's it. Right. So, and we've only really used one revenue account. We call that fees income. And then everything else that was an expense account, of course, that's temporary. And then of course the drawing account. Now, remember the revenue and expense accounts are your income statement accounts. So one way to kind of remember this is your temporary accounts are anything on the income statement plus the drawing. And if you can remember that income statement is revenues and expenses, and then the drawing, that's it. These are going to be the accounts, your temporary accounts. That's what we're going to be working with in this chapter. We're going to be closing these out, resetting these, and then at that point, we're going to be using those then for the next period. It's just a reset. So the accounts that are on the balance sheet, which are what they call the permanent accounts, we do not zero these accounts out. And in fact, the only permanent account we're going to be working with in Chapter 6 is the capital account. The capital account is a permanent account, but that's essentially where all these numbers are going to be flowing into. So all the revenues and expenses in the drawing account, we're basically going to be transferring those balances into the capital account. This is kind of like your statement of owner's equity that you've done before, where you start with beginning capital, you add net income, subtract drawing. So you've already prepared the equity statement. What we're doing in this chapter is kind of following that equity statement, but it's just the process. It's just the process of making sure that the ledger is updated. And so all those revenues and expenses and drawings are going to be transferred into that capital account. So once you've done that, the capital account balance that's in the ledger would be the balance that would then show up on the balance sheet. All right, so that's just in a nutshell before I put up the PowerPoint. That's just a preview, really what we're going to be getting into. So let me pull up a little bit of the PowerPoint now. And again, you guys have this. So let me, if I can get my screen to reshare this. All right, so here we go. So here is, again, the PowerPoint. Again, I've already recorded this, so, but you can add this to the video that you can also watch in Blackboard. But where we're at from the textbook perspective, if you look at the accounting cycle, you'll notice that we've already done really up to their step 6, and we're really working on step 7, which is today, journalizing and posting these things called closing entries. Now, I just mentioned this concept of temporary versus permanent. Now, they throw one more temporary account into this chapter, and they call it income summary. And don't worry about this. This is an easy one. We're going to use this account, and I'm just following your textbook. I don't suggest every business does it this way, but just for this purpose of this class, the income summary account is going to be used solely to help you or to assist you to close out the revenue and expense accounts. All right, so we only do it in the closing. This is the only time you're going to see this account used. It will not show up on any financial statement. It's just kind of like an in-house tool that we're going to use to assist us to prepare these closing entries. Okay, so let me get to the steps. So first of all, we're going to do this closing in 4 entries, 4 steps. And if you notice, and we'll just do it, and by the way, it doesn't really matter what order you do it in, but we're just going to follow the order that they tell us to. So the first one, notice what they tell us. First step is going to be to transfer the revenue, which will be fees income, into income summary. At that point, the second step will be to transfer the expense accounts into income summary. So these first 2 steps, all we're going to be working with is the revenue and expenses. And then step 3 is we're going to determine what our balance then, just like you do an account balance and income summary, and we're going to transfer that into capital. So the first 3 steps, we will close out revenues and expenses and the income summary in 3 steps. And then at that point, we've updated capital. The last step is going to then be to deal with the drawing account if you have one, if there was any drawing. And we'll take that drawing account and they're just going to close that directly to the capital account. All right, so just for the first examples I'll show you today is we're going to follow this approach, and then later on we'll talk about other ways you could do this. There's different ways. Businesses don't always do it just exactly like this, but the outcome is always going to be the same. The objective is always the same, which means that we're going to take these temporary accounts and put everything into the capital account. So let's show you first the example of how you would close out that fees income. So this would be like your step 1. And you'll notice, just look at the entry, notice you're going to be debiting fees income because that's a revenue account, and then they're going to be crediting income summary. That's it. So debit fees income, credit income summary, that's the entry you would record in your journal, and that's all you got to do. Now, that would be your journal aspect. So as I do this, and I'll go back and forth here, I also want to look at the ledger aspect. And on this slide, they're showing you right now that was fees income, and that's your revenue account. Notice if it should have a credit balance. By posting that as a debit to fees income, notice that that's now at 0. And that's what your ledger would look like after you posted that first closing entry. And then if you look at income summary, after you've posted, you're basically taking this balance of fees income and you're transferring it over to income summary. And that would be step 1. All right. Now, once you've done that, then we would then do closing all the expense accounts. And again, because expense accounts have debit balances, what we would be doing is we would be crediting the expense accounts to close all those out. So in this case, I'll just show you a couple examples. Let me first show you an example of how it would at least look like. So when we go to do our expense closing, you notice that they like to put it in one compound entry. So in this illustration, they've got 5 different expense accounts, okay? And you got salaries, utilities, supplies, rent, and then depreciation. And what they did was they put these as credits. And of course, they added them up, and then they got one debit of $13,333. So what's happening here is by crediting these expenses, and then posting them to your ledger, these accounts would then have a zero balance. I'll show you that in a moment. And then income summary would then have $13,333 then as a debit. And then at some point in time in step 3, we would then have to get the income summary balance to close it out. So let me show you the ledger. Here's your ledger after you would have closed out those expense accounts. You'll notice that all these accounts that say expense, notice that they're all credited. In red, that's the credit posting. Notice every one of them then have a zero balance, and that's all you do. And then at the income summary, notice there's the revenue of $47,000, and then the expenses have now been debited at $13,333 into income summary. But we're not done with income summary just yet because we're going to have to close that out in a moment. But at this step, we've just taken all these expenses and put them into income summary. So I like to think of the income summary. Since we're using it, it's the debit side is going to represent your expenses, and the credit side is going to represent your revenue. So basically your net income. And so eventually we're going to get a balance in income summary. It'll just be 47,000 minus the 13,333. And then that would give us a balance of, I believe it's 33,667. It'll then have a credit balance, and we're going to have to deal with that in a moment. But that balance would represent, in this case, net income, because our revenues are, of course, more than our expenses. So after that part, what we would then do is, I'll go to that part. So then, of course, this would be your balance in income summary, 47 minus 13,333. There's your balance. That's basically net income. Notice it has a credit balance. We now want this to go to zero. We're going to take this amount and transfer it to capital. So the next step is we want to close this out again, transfer it to capital. And what will happen here is, first of all, the journal entry will look like this. We're going to be debiting income summary, crediting Trayton Eli Capital for that 33,667. Okay, that's what the journal entry would look like. And then once you've posted that, what will happen here is this is what would happen in your ledger. Notice income summary had the balance of 33,667. We debit it to go to zero, and this balance then gets transferred over to capital as a credit. Okay, so at this point, if we started with $100,000 in capital, we're adding another $33,667 to its balance. That would be the balance on the balance sheet. Now, the only other thing we then would have to deal with then would be if there's a drawing. And in this illustration, once we've done that, I think the drawing had 5,000. What'll happen is you'll have to credit the drawing, just like you credit an expense. And notice you debit capital for 5. That's the entry. That's what it would look like. And then in the ledger, what would happen is look at the capital account. There's after you'd closed out your expenses and revenues. Notice now we got to close out the drawing. Notice the drawing is now at zero. But the capital account now, you would have what? The 133, subtract out the 5,000. And then at that point, the new balance in capital would be at 128,667. That's the goal. All right. And I'll recap this again in a minute, but this is essentially what's happening with capital. Is you have a beginning balance, and then you're going to transfer in any net income or net loss. In this case, we closed out revenues and expenses. We then transfer if there's any drawing, and then we get a new balance. Okay. And then the next slide I just want to show you real quick is just the summary. This is essentially all the 4 steps. Step 1, close out revenue. Step 2, close out all your expenses. Step 3, close out income summary. And then step 4, close out the drawing. So we'll do all these in a moment, and we'll go into Connect. We'll do all these together. We'll do these entries. This is your journal. You have to post them to your ledger. Once you've done that, your ledger's reset. You're ready to go for the next period. And then the goal eventually will be to make sure that that capital account is updated. Okay, so this capital account right here, we have to update it by transferring all those temporary accounts into capital. Remember, we're not closing the capital, even though it's the only permanent account that we're using. We're not closing it out, we're just updating it. Okay, so if you want to think of kind of like the two primary objectives of closing is, number one, you could say we're zeroing out the temporary accounts, and then the second objective is to update capital. Okay, so other than that, there's nothing new in this chapter. The financial statements are the same, the ledger journal concept's the same. It's just that these are the last, we're going to call them 4 entries that we need to do at the end of the period. And what happens is you're getting the books ready, the ledger ready to start tracking new expenses and new revenues for that next period. Okay, we used to do this a couple companies I was at. It was interesting in terms of the processes back. You know, we have different technology now, obviously, but we had one company. We did 2 weeks. It took us 2 weeks literally to work on the closing. It's unreal. To think it would take that long to close out the books and reset everything is unreal now. But another company I was at, it took us about 3 days. It was a little bit smaller. The setup was a little bit different. But you know, with the advances in technology and some of the changes with the real-time accounting, a lot of this closing stuff is done much quicker. But again, just showing you, this is the basics. This is the idea. This is how you do closing. Okay. All right, so let me stop for a minute. Does anybody have any questions on what I just showed you? So I'll stop for a moment, just to pause for a moment to see if anybody wants me to go back over anything before we pull up the problem. Any questions on what I just showed you about the closing entries? Anybody? Anything? All right, so this is, again, just a recap, but again, we're going to go through these step by step in a moment. But even though I've already recorded this, I just wanted to talk to you verbally, just to give you another heads up. You're seeing this live right now, so that way when you go back into Blackboard and watch my lecture video on chapter 6, and then compare it to this, and then of course we're going to work a couple problems here in a minute. And then once you've done it a few times, it's actually pretty easy. You just have to know what to recognize. All right, but any questions before I'm going to bring up a problem here in a moment, and we're going to go through these 4 entries together. I'm going to bring up your Connect homework. We're going to work at least 1 or 2 together right now. But any questions, any issues on what I just said? I know that was pretty fast, but I wanted to make sure I got that in today, just so that way you've got another recording of it. You can go back and play this again anytime this week once I get it on Blackboard. Okay, if there's no questions, let me do this. So let me pull this up. I'm going to change my my screen here. Hold on just a second. All right, so I'm going to get into the student view here in a moment, and I'm going to be into chapter 6. Pull this up. And on the chapter 6 homework, you open this up. Let me get in. Hold on just a second. All right. And I'm going to change my screen because I think it'll be easier if you see it on my second screen. It'll be easier for me to share. All right. So what you're looking at here, let me know if you cannot see it, is everything here. This is your problem number 1 with your chapter 6 homework. Okay. And so there's a couple different ways they throw these at you, but we'll just kind of start with this one today. And what they're doing here is they're giving you a preview of their ledger. Notice they don't show you T accounts. I wish they did, by the way, but they didn't. But it just says, this is the ledger of Hunter Company. It says contain the following account balances. So this is everything the company is using: cash, AR, supplies. Notice you've got capital, drawing, fees, income, and here's all your expenses. That's it. Notice they tell you that all accounts have normal balance. That should mean something at this point. When they say normal balance, that means the increase side. It says prepare the closing entries for the above transactions. So what I like to do in this problem, just to further illustrate, give you my illustration, of this is to, I like to use T accounts just as our ledger visual, and then we'll do the closing. So the first one that we're going to work with is the fees income. And by the way, one more thing. Remember I talked earlier about temporary versus permanent accounts. So there's going to be several accounts, lots of information they'll give you in this chapter. Some of the accounts we will not even work with. They're just going to be in there. So we don't have to worry about cash or accounts receivable or supplies. Literally everything down, these first accounts, cash, AR, supplies, equipment, accumulated depreciation, accounts payable, those are all your permanent accounts. So we're not going to be even touching those in this chapter. We're going to be working with everything else. The capital, we're going to be updating. And then everything over here from the drawing down to all the expenses, those are all your temporary accounts because those are your revenues, expenses, and the drawing. Those are going to be the accounts we're going to be working. So the first one we'll do, the first entry on this, and of course it says journal entry worksheet, don't worry about that, but step one will be to close out that revenue account. So here's my visual. So if we were in our ledger and we had fees income, right? So there's my T account, there's fees income. The normal balance for fees income, you would all say, is on the credit side, right? So that would be 53,750. That would be our balance right now. That's what would be in the fees income account. So our goal right now in this first step, we want this account to be at 0. So to make this account go to 0, we're going to have to put a debit in the fees income for whatever balance it is. And that debit will be for 53,750. We're going to put down. Once we do that, the account will then be at 0. But remember, we have to put it somewhere. So we're going to follow their approach, and we're going to put that into income summary. So I'll just draw my T account, there's income summary. We're going to put this 53,750 into income summary as a credit. So here's what will happen. So our journal entry is going to look like this. We'll go down to the journal, click that drop down arrow, find fees income, and then we're going to enter 53,750 as a debit. We then click the next row, look for income summary right there, put a credit of 53,750, and then in a moment you still have to hit that record. So we'll record it and then we'll post it. But I hit record. That's all you do on the first entry. And eventually, when you would post it, they don't want you to post. This probably deals with the journal aspect, but once you post this to income summary, it would look just like what I'm showing you right here on this T account. Income summary would then have a credit balance of 53,750, and fees income would then have a 0 balance after you posted that. So step one, this is all you do, just find the fees income. You're going to debit it to make it go to 0. That's how you reducing it. That's how you reduce revenue by debit. And then we have to credit, we'll credit income summary. So any questions on just the first entry? I'll just do these one at a time. And if you need me to go back over and say anything, repeat anything, just let me know. We have time. Any questions from anybody right now on just the first closing entry on what we're doing here on this visual? Again, if there's no questions, I'm assuming it's making perfect sense to you. It's very easy, right? Let me hit record too so I get this out of the way. So anything at all from anybody on what we just did? No, we're good. Okay, so the second entry then is going to be a compound entry. So what we're going to be dealing with is just the expense accounts. Looks like we've got depreciation, salaries, supplies, telephone, and then utilities. And these are pretty easy to remember. You just look for the word expense. There's no tricks about this one. So we've got, looks like 5 expense accounts. And all these amounts, we're going to be putting those into income summary. So remember to close out an expense account. Again, here's a little visual on this one. So just take one account. Let's take one of them. So let's say we've got depreciation expense. So if I wrote out depreciation expense, and of course this is our ledger idea, and my stylus doesn't want to write. Anytime good old technology, anytime I change screens or I lean over, sometimes my stylus makes me write kind of funny here. So let me see if I can get this better. So we've got, all right, depreciation expense. Here's my T account. All right. So it looks like we've got $27.50. That would be on the debit side. Remember, that would be a debit balance. This is your rules of increased side, normal balance. So if our balance for any of the expenses should be debit, if we want to make those go to zero, we're going to have to put a credit into that expense account. That's why we credit them. So if we credit depreciation expense for $27.50, which we'll do in a moment, and then post it, that'll make that go to zero. That's the visual. That's what we're doing. So all you got to do is we're just going to locate all these expenses. So we'll go down. And remember, we're going to be debiting income summary. So just for default, I'm going to find income summary. We're going to add these up in a moment. But let's just list these. So let's find depreciation expense. And let's see, they probably didn't put these in the right order, but we'll see. So if I find depreciation, there it is. And then let's see, I'm just going to take these in order. Then we've got salaries expense right there. And then we've got supplies expense right there. And then telephone expense right there. And then the last one is utilities. So I'm just clicking the arrow. You can find these when you do these. There it is right there. All you got to do is just copy the number. So depreciation expense, put a credit, $27.50. Salaries expense is $17,000. Credit. Supplies will be $3,000. Credit. Telephone is $2,600. And then utilities is $46.50. At this point, and I'll do this in a moment because I don't know what the number is. I just got to add them up. To add up all your expenses, if you take $27.50, $17,000, $3,000, $600, $46.50. I get right at $30,000. And we're going to be debiting income summary for $30,000, and that's it. So again, I just put up one T account for depreciation expense just to illustrate, just to make sure you understand the ledger, the posting concept. But any of these expenses will have debit balances, and once we post into the respective expense accounts, those expense accounts would then be at zero once we posted those. This income summary, which when we post this as a debit, what would happen with that? But we would then have income summary on the debit side, have that 30,000. So we post that, income summary would have 30 debit, and credit was at 50 revenues, so 53,750. The revenues, and then here's your expenses. So that's why I call it income summary. Once we do step 2, step 3 in a moment, step 3 will be income summary account. So if I have income summary up right here, we would have to get a balance, and of course the balance is going to be 23,750 on the credit side, because that's going to represent the credits, taking the difference between the debits and credits. And because the credits are larger, it's going to have a balance on the credit side, and that's going to represent, in this case, net income, because the revenues are more. Okay, so just this entry right here is once I record this, it gets posted, and then your expenses are at zero, and then your income summary would then be at 23,750 on the credit, and then we're going to have to deal with that in step 3. So if I hit record, notice then the third entry will say record the closing entry for the balance of the income summary account, which in this case, we're going to have to close that out in a moment. All right. But before I do that, are there any questions I wanted to show to anybody on just the expenses? Anybody? I'm hoping that this is pretty linear because there's not really a lot of critical thinking that you really have to really analyze. There's not a lot of analyzing in this chapter. You just have to, it's more knowledge. You just have to know which accounts, which are temporary accounts, find them, make them go to zero, and then do your updating. At this point, we're just kind of like cleaning up the books. That's all we're doing. It's not like in the last chapter where you had to look at dates. You had to look at what time period. In this case, you just go to your ledger, find your temporary accounts, and then just enter them in these four steps. This is our step number 2 to close out the expense accounts. That's okay? No questions? Okay. Step 3, notice it says for the closing entry for the balance of income summary. And right now our balance is at $23,750.
Hello?
Yes, Anthony. Question.
I was just gonna ask, am I the only person hearing static?
Can you hear me? Is it better now?
Yeah.
Okay, probably because I stepped away from my microphone. I apologize. Is it a little bit better?
It keeps like cutting in and out.
Yeah, it's the best I can do right now. I don't know what, every other day sometimes is good, but some days it's bad. Can you guys at least see my, I'm trying to speak, make sure I'm speaking closer to my mic. But can you hear me now?
Yes.
A little bit better. Make sure I, please speak up if anybody, just let me know if you're not hearing. Don't be shy. Okay, so at this point, I am looking at the income summary, and we want to make this account go to 0. Okay, so to make this go to 0, we're going to have to debit income summary. Once I do that, it'll be at 0, and then once we make it go to 0, then we're going to put that into capital. So I go to the journal. I'm going to find the income summary, and then I'm going to find the capital account in the second row, right there. All right. I'm going to enter a 23,750 debit and a 23,750 credit into capital. So up to step 3, once I've done that, at this point, let me get my status back. So income summary will then be at 0 because once we put this debit as a posting in the income summary, and my status is way out because so at this point, I'm just going to put 0. Is that just to try to visualize you're at 0. Income summary is closed out, and now we've just done the first 3 steps, first 3 entries. So we will be at a point where we hit record entry, where the last step would just be to close out if it's drawing. Okay. So just to kind of recap, if I look at the journal right so far, notice we've got step 1, which is closing out base income, your revenue. Step 2, close out your expenses. And then step 3, close out income summary. That's where we're at right now. Okay. I can get a little bit closer. Is that any better at this point, guys? Let me know right now. I'm just doing a little bit of test on my mic. If you can't hear me, just let me know. Okay, so looks like we're a little bit better now. All right. So at this point, these are the first 3 entries. Notice the second one, when I closed out your expense accounts, this is a compound entry. Okay, so you just combine them all, and then just put one large debit to income summary for your expenses. Now, the last one is there drawing. Now, the drawing account right now looks like it's at $26,000. All right. So what they're saying here is if you, again, in your ledger, I'll draw this out, drawing my T account, if it has a debit balance of 26,000, we want to make this account go to 0. Our closing will be to credit the drawing for 26,000. Once we do that, it'll be at 0. So what we'll do is we'll credit drawing. If the debit something, the debit is going to go to capital. So on the fourth entry, I'm just going to bring up capital, find it, and then credit the drawing. Sometimes you just have to search where it is. And it's going to be a debit, 26,000, and a credit for 26,000, and that's it. I'm going to hit record, and then just bring up the journal once more, and that would contain all of your 4 closing entries. Okay, so at this point, revenues, expenses, income summary's done. The last one, notice they don't use income summary, they just close out the drawing directly into capital. Okay, so at this point, there's that 26,000 credit drawing, and you're done. Okay, now the only thing they didn't do, I'm going to bring up one more thing. Let's see if you have any questions on this. The only thing they didn't ask for in this problem was what would be the balance of capital after you post your closing entries. So what I would look at like this, so you've got capital right now, right up here, it's 60,750 was the beginning balance. So if I draw up my capital account, this is essentially what happened in your ledger. If you started with $60,750, that would be your beginning balance. And if I look at these entries, it looks like I put a credit of $23,750 into capital as a credit, and then I debited capital for $26,000. That's how your ledger would record all this. So it's like saying your beginning capital, you are adding net income, and then you're subtracting the drawing. So if you take the $60,750, add the net income, and subtract out the drawing, that's going to give you right at 58,500. And so at 58,500, let me circle that. That would be the balance that's on your balance sheet. And that's what your ledger would be doing. That's what your ledger would then be updated. So this 58,500 is also what would show up on your equity statement when you did that. So if you think back to all the problems we've worked up to this point, where you had to do those 3 basic financial statements, your income statement, equity statement, and then a balance sheet. Essentially, you've already done this. You've already prepared an equity statement, so you already know how to get any capital balance. You've already done this. This chapter is just showing you internally the accounting process on how you get that, on how you get that capital balance to be updated. Okay.
It probably should have died. So you don't need it? You're on the
All right.
phone.
Are there, all right, so are there any questions? Let me pause here for a moment. I've just showed you in a problem, I've just showed you the 4 different entries. And I also tried to illustrate the impact in a T account visual on how this also impacts your ledger. And I also showed you how we go from a beginning capital balance of 60,750 to an ending capital balance of 58,500. This one problem covers all of the concepts that you got to be doing, or most of the concepts, probably 99.9% of the concepts in chapter 6. There's only one more thing, what they call the post-closing trial balance. We'll talk about that a little bit later. That's not a big deal, but this is the meat of the chapter you got to get down. Okay. All right. So I'm trying to speak closer to my mic so you guys can hear me. Are there any questions? First of all, on the entries that I just put up here, these 4 entries, or also on the impact on the ledger accounts and what we're doing here. Any questions? Is anything, did I confuse anybody? Any confusion on what I showed you? And I'll keep in mind it's a Monday and we didn't have a Wednesday last Wednesday meeting, but at this point, it's a pretty linear chapter. There's not a lot of curveballs in this chapter. It's pretty straightforward. You just have to follow the steps and then plug it in. And guarantee at least you can, on the exam, you have to do at least one of these problems on the exam where I'll have you do all the 4 entries, definitely. Okay. Am I coming in clear, not clear? My audio? Questions? Okay, if there's nothing, I'm looking to see if there's any comments just to make sure. Question. All right, so I'm looking at it's 10:45. Let me at least start one more problem. I just want to show you one more problem just to kind of start it. Again, because I know I can't get it all done in 4 minutes, but before I get there, just let me remind you, if you go into Blackboard this week, today, tomorrow, watch my lecture video, watch some of these homework videos and stuff I put in Blackboard. When you come back on Wednesday, we'll do a couple more of these, and then that's really it. That's all of the cycle, and then we're done. Okay, so there's not, once you've done this, this is really the entire chapter. I know it seems kind of crazy. So just give me a heads up, because I do believe on Wednesday, once I work through another problem or two, that'll be it for chapter 6. And at that point, I'm kind of like ready to talk about the exam for the next week and talk about what's going to be happening the next week. So just giving you a heads up so you know what to prepare for Wednesday as well. All right, let me go to another problem. I'm going to leave this problem. I'm going to problem number 4 just for a moment. I like this problem. So in problem 4, it's basically the same thing that I just showed you with one exception. In this problem, notice they always start with the ledger, because they're essentially saying they've done all the adjusting entries. We're just cleaning up the books now. We're resetting the books. That's where we're at. So they give you all these accounts. Notice they always start with cash, then you have accounts receivable, all your assets. They give you all your permanent accounts first. They always do that. And then they always tell you all accounts have normal balances. Okay. They want us to prepare closing entries. So that's the same as problem 1. But the thing that's different is in this problem, they also want you to post to the ledger. So I really like this problem because it really makes you manually do it one by one. It ties it into your brain so you know what we're closing, you know the accounts that we're affecting. And so then it says, remember to enter all these beginning balances into your ledger as well. So this problem does, in a way, what I just showed you in problem 1 when I drew my T accounts. They just don't use T accounts. They use I think they use a 3-column ledger in this problem. So just to kind of heads up, so in this problem, what we do is it's pretty much the same thing. And so notice there's your fees income, which is 374,460. I don't know why they're using some weird numbers. Why can't they just use large, why couldn't they have just used 375,000? I have no idea. But 374,460, we would close that out. So let me just show you this one. So what you do here, I went to my journal. Notice this entry 1 would say to close out your revenue. So I would look for the fees income. Let me find it. It's right there. And then income summary. Right there. And then all you got to do is enter that number. It's 374,460. Debit 374,460. Credit. So once you've done that, I'll record that. Let me view the journal. Once we've got that in, let me show you what you have to do. Just want to show you how their ledger looks like. So I went to my ledger, found fees income. Here's your ledger. And notice that you have to go to this cell right here. They make you enter the balance right here. You have to enter that from that beginning number. So if I put that balance of 374,460, you actually have to do that. And then when you record that posting, that debit posting of 374,460, notice that when you do that, they already have a formula in here that will show you that the balance should be 0. And that's what you're going to have to do. Okay. So for all these accounts they're giving you in this problem, you have to go to this balance cell for all of them and enter those balances and then do your posting from your journal. So, and of course, income summary right here, I would put in that credit 374, 460. That would represent my credit, my first credit posting. When you do the expenses, the expenses will go right there in the income summary. And then eventually you'll have to use this last row to close out income summary. Okay, so again, I'm just about out of time, but just to kind of, as we're starting this chapter right now, so this is a good problem when you go in there and look at it. So you have to do all your journal entries, and then they actually make you post to your ledger. And then I like this problem then because they also have you update the capital balance. Okay, all right, so I'll stop there. So again, I'll get this thing posted on Blackboard today. We'll work a couple more of these problems on Wednesday, and then that'll be it for chapter 6. You know, the Wednesday assignment I think I have listed in Connect. It should be due by this Sunday, which is, I guess, November 1st. Today's the 26th. So just to give you a preview, so I believe Wednesday, come and ask questions. We'll do a couple more of these. Let me know if you're struggling on anything in chapter 6. And then at some point in time on Wednesday's class, we'll talk about the exam. I'll have a study guide and a couple things that'll happen next week in addition to exam 2. Okay. All right. So final thoughts to wrap this up. I know some of you may need to leave to go to another class, but any issues, any other questions on what I just showed you today? All right. If there's nothing, I can hang on for a few more minutes. If you need to leave, that's fine. I'll wrap this up. Again, this is recorded. I'll post this on Blackboard here in a minute. You can watch this in addition to my other videos in the learning modules. And then just work a few, I would suggest everybody work a few of these before Wednesday's class. And that way you'll truly know if there's something you're not seeing, you can ask specifically. And then we'll wrap this up. And then again, at some point in time, we will talk about exam 2, which is essentially scheduled for next week. Okay. All right. Thoughts, questions, anything else? I know I was fast. I had to talk pretty fast the first few minutes because I wanted to make sure I wanted to try to give you a live illustration, and I wanted to see what the problem and see if you had any questions. But there'll definitely be a lot of time for questions on Wednesday if you have it. So if there's nothing else today, anything at all before we leave? All right. If nothing, I'll wrap this up, guys, and just email me if something else comes up, and then we'll see you then on Wednesday.